Should be able to hear me now. It helps if you plug the mic in. Just let me know if you can hear me. I think there's about a 10 or 15 second delay on the stream. Yeah, you can hear me. All right, cool. I should be able to hear me now. Yeah, that's good. Just tested it out on my side as well. Right, we'll wait for a few more guys to come in, and for those of you with questions, I know there may be a lot of you, there may be a few of you, you can post them in the chat and then I'll start going through all of those questions. Anything you would like to know or ask, now's the time to do it. If you've been following my posts, what's up, Cuban? So if you've been, what's up, Zenith? So if you've been following any of my posts, you were interested in any topics or models in specific, now is the time to ask all of those questions. I think the last stream we tackled a bit of Flash. I can't remember offhand how much of Flash we tackled. Reno, yeah, we just started the stream. Didn't really start it yet, but yeah, just started. How can I trade your systems mechanically without multi-time frame analysis? Example based on ONS. So ONS is a public knowledge right now. So I suppose we can talk a bit about that. What time frame are you mainly executing? 5 looks clean, flash or zoom, but is this also what you use? Yeah, Zenith, M5, M1, wherever it shows up, right? Wherever it shows up, I'll show you, and I've got the right person here today, I'll show you what they call a Coke Boy model. And it's kind of based on a turtle soup and some core understanding of what the change in the state of delivery is after liquidity has been taken. We'll run through a few examples of what you should be looking for when you're looking for reversals, ideally what should be there, and most importantly, I'll tell you about the sequence of steps, right? The sequence of steps that need to be present for you to confirm or take a reversal setup. Yeah, how do you grade the setups? We'll talk about grading a setup and what makes one particular setup more higher probability or a higher probability than another. What do you use as a point of interest if there's an OB range but FEG just above that? So Potato Man, I'm not sure what you're talking about if there's an OB range but an FEG just above that, right? So if we start with your question, then let's look at something visibly clear to us, right? Here is an OB range right here. Why is this an OB range? Well, in order for us to understand why this is an OB range, we need to understand what an OB is, right? The definition of an order block. And the best of order blocks would be, should ideally form at a point of interest or high time frame point of interest, right? And specifically, the OB should take liquidity, and then there should be some kind of displacement on the other side, and then there should be market structure shift, more importantly, a change in the state of delivery, right? I posted a video the other day, which I made public, which is basically talking about the OB model itself. Some of you can go back and reference that. And there's a few things that we can meld together to use these things, right? So understanding what an OB is very important. First of all, what makes an OB an OB? How is a bearish OB a bearish OB? How is a bullish OB a bullish OB? What validates an OB? What validates an OB? How do we confirm? How do we play retracements? All of that, right? So in order for something to be an order block, we said that a bearish order block would form, and this is according to ICT now, right? It is not according to ICT what most traders use, or retail traders or non-ICT traders use, where they look at OBs that are at the extremes, right? In order to qualify for an OB, in terms of ICT, we would have to take liquidity, right? We would have to take liquidity. Here you go. And it is the entire series of up candles in this case. It's not just one specific candle in terms of ICT teaching or ICT methods, right? It's the entire series of candles. And that order block range, according to ICT, is validated as an OB when we trade through the opening price of that OB. So in this case, according to ICT, it would be right there. If we wick through that opening range, that causes a change in the state of delivery. The validation of the order block is as we start trading through the lows of up candles, each of those become validated as order blocks, right? But the change in the state of delivery actually occurs, according to ICT, when we trade or wick through the opening price of the entire series of candles that are formed, right? For me specifically, I want to see closes below the lowest down candle low, right? So if I had a high here and we had the low of the range before the liquidity or the manipulation leg or turtle soup Judas run up, this lowest low that is formed here, this is what I want to see being closed through. For me, this would be my change in the state of delivery. This is when we can now do things like this, right? Body to body, market off body to body, and this is the range that we would use either zoom logic, right? Zoom meaning we had a phase of accumulation, we had the manipulation above the accumulation, and then we had displacement or the change in the state of delivery, retracement, and expansion, right? Flash specifically does not give you a higher high like Zoom does. Flash would be a lower high which leads to a lower low, right? So that's the key difference between Zoom and Flash. All boil down to the specific, which we call the OB model, right? They all rely on the same OB model, which basically dictates that once we have an OB range identified, validated, change in the state of delivery, if there are any imbalances inside the range, now in this particular case you had this huge imbalance right here, and I'm not interested in the entire imbalance itself. I'm only interested in the portion of the imbalance which falls within the OB range, right? So from the opening price or lowest candle body to the high of the FEG, this is the range that I'm interested in. Secondly, I'm interested in 50% of this range. We want or always want to see 50% of this range being mitigated at some point. So they're either going to draw back into 50% and then drop lower, or they will create inducement liquidity like so by a first tap into the range that doesn't necessarily get to 50%, right? That's inducement. And then they could either create inducement or trendline liquidity, whichever you want to call it. And these are relative equal highs or highs that lie below your point of interest, which is 50%, right? So we would ideally only be looking for entries once the inducement liquidity is taken out and we get the setup form, either flash or zoom, at or around the 50%, right? So once we get that happening, we could default from the original OB to a new one, or the most recent one created once the 50% of that order block has been mitigated. We could do that. We could do that, right? Body to body, this in particular is a single candle. There are instances where people take the entire range. I'm talking about the lowest low to the highest high that created the OB range. I use body to body, so whatever the lowest body is to the highest body, this is the range. Then again, it boils down to what? Is this a flash range? Is this a zoom range? In this particular case, it's a flash range because we had a high here, and then we had a clear run on liquidity. We had displacement here. Now, I'm not interested in so much so in the FEG here. I'm only interested in this FEG to frame a market structure shift, right? And the market structure shift would be framed using opposing FEGs. So once we trade, remember these FEGs that get created on the way up in a manipulation leg, these FEGs are meant to contain price and send price higher. So a form of market structure shift would mean then if this FEG is fair value for buying and was supposed to have sent price higher, why have we now closed below it? So this is where the inverse FEG comes into play. But the inverse FEG works well because it's an FEG that was fair value for buying. Once we close below it, like so, it becomes fair value for selling, right? The inverse from buying, they become fair value for selling, right? But I'm not interested in particular about this specific IFEG. If we go down to what the OB model tells us, we had a run on liquidity, there's a high, there's the run on liquidity. More specifically, we are looking for closes below the most recent down candle range low, right? We could use this one, we could use this one. Let's use this one here, right? We went up, we went down, and then we went up. So let's use this range right here, right? This up candle low here, but it started the move up here. We could even use the down, let's use the down candle range, even better, right? Now, a change in the state of delivery would mean we'd have to close, for me, close below the down candle range low. And that only occurs on this candle right here. So when we talk about the order or the sequence or steps that need to be present when framing this, we know that we want to see a clear run on liquidity like we did here. We want to see market structure shift, which we have already framed in the form of a bullish FEG being closed below. This is a form of market structure shift. So number one, we want to see an OLR, right? An opposing liquidity run, a manipulation, a Judas swing. Number two, we want to see market structure shift. And that is when there's an opposing FEG being closed below. And number three would be the most important step, which many fail to adhere to or look for, and that's why they say, hey P, why did this fail? Why did this fail? And it's the closing below the most recent down candle range low to the left of current price action, right? So once this candle closed below here, we can frame CSD. So number three is a very important step. Once we have framed CSD, the sequence in the delivery would mean we expect a measurement of retracement, right? Retracement, which you see coming in here. And where would you look for that retracement? Again, it boils down to OB model logic that I've given you on YouTube, two different versions, one with captions, one without. and that would mean we would default to OB model logic, and that would mean we don't use the IFVG that was framed for the market structure shift. I'm not saying you can't use it. I mean, I don't use it, right? It would mean that according to the OB model, we would need to identify firstly the range, or the OB range, which we have. We need to look for that CSD which has occurred here. So we know that any retracements back into the range, we want to look for short entries, right? And that would come in the form of the imbalance inside the range. I'm not talking about the IFVG or the market structure shift. I'm talking about the imbalance created on the way down when we confirm the CSD here. That would be this guy right here. So when there's imbalance inside the range, we are looking to trade the imbalance or 50% of this range. Remember guys, we always want a situation where 50% of the range is tagged. If we don't tag 50% of the range, they could have done something like this. Retrace here, leave that 50% untapped, wick here, which they did, right? Come back in, tag the 50%, take the liquidity out here, then we start moving. You see that? So it's all about understanding how liquidity is engineered or generated, and this is one of the ways, right? They create low highs below your point of interest, which is the 50%. They move away, sucker in stops here and breakout traders, run back up. People who have put their stops above here or above here, stop them out, then the real move happens, right? So waiting for that 50% to happen, especially when there's an imbalance inside the range, we trade the imbalance or 50%. So your position would then either form, if you are an aggressive trader, right? The second stab, right? It's a second stab. Now, the concept of the second stab, which means we've created this change in the state of delivery once we close below the range, right? And we had a first stab back into the range. When that first stab happens, what do you think you would have done? You would have said, hey, this is where my entry should form, right? There's the imbalance here. As soon as it comes in here, I'm going to take my entry, stops above the high or above this candle that created the FEG. And then, so you do this, right? You do this. Let's say you had your short position at the opening of the imbalance, stops above there, and you were targeting either this low or some low to the left, right? Some low to the left. And as this started to move down away from your level and through here, you then brought your stop back to break even. What happens next? The early buyers, or in this case the early sellers right here, get taken out. And if you look closely or carefully and study what happened here, we don't do anything until liquidity is taken or until there's an opposing liquidity run right here. So when we look at this, the sequence is then OLR, right? Which we had up here. The market structure shift, which we framed using this MSS when we closed below the bullish FEG, which was fair value for buying, becomes fair value for selling. The CSD is confirmed when we closed below the low right here. This is when we start to cook, right? So in actual fact, if you were originally short, you should have done something like this: 50%, stops above the high, right? Depending on the time frame you are. Don't worry about what this stop is right now. We could have refined it on a much lower time frame or degree, and then target something down here to the left, right? In terms of targets, you know I'm a big fan of the Dexter fibs, and that would just mean fibbing the OLR or the manipulation leg, the entire leg from the bottom to the top for a bit for 2 to 2.5 standard deviations. There you go, right here. Let's take 2 as the lowest hanging fruit, and that's your objective, $171, and this is a 5-hour trade, right? But understanding that mitigation of that 50% and liquidity needing to be taken first before moving, doing exactly looking for liquidity here, right? Looking for the liquidity. Don't be the liquidity, look for the liquidity. There's always going to be a case where you get a first stab into the range and price may move away. And then that second stab comes in and takes out the early sellers, then we move, right? Now, once we have step 1, OLR, step 2, market structure shift, step 3 is the CSD, step 4, after the change in the state of delivery, when we have closed below a down candle body range to the left of current price, I'll share the FIB setups, it's a Dexter FIB setup. After we've closed and confirmed the CSD, there should be a measurement of retracement. If you are impatient and you want to just start selling right here, look what happens, right? So understand that when we take out a swing low to the left of current price action, especially if these lows are what they call protected lows, which are lows that led to new highs, if we are still bullish, they should never take out a protected low. They can take it out, they can wick, they should never close below a protected low. So this is telling you we've closed below here, we've closed below here, they've closed below a protected low. The change in the state of delivery or order flow is changing. We come in, we don't tap the 50% of this range right here. We go down, we draw in breakout traders and any stops that are resting below here. We come back, we take them here, then we move, right? Now, when you expect or understand what I'm telling you now, please understand what I'm giving you is a sequence, a core sequence of events that need to occur for you to be profitable and grade your setup as an A+++ setup, right? We need an OLR, we need market structure shift, we need a change in the state of delivery, there should be a measurement of retracement, right? And the final step should be expansion, right? These are always going to be the steps that you are looking for. OLR, MSS, CSD is the most important step. If you do not get that CSD, right? And I'll show you an example right now. If you do not get that CSD, you don't even need to look for retracement and expansion, because not getting the CSD, there's no change in the state of delivery. You might as well stay with what the current order flow is, and if that order flow is bullish, stay with it. Stay with it. Don't be bearish. And the perfect example would be we can trade above a high, right? This is why it's important to know where your point of interests are, because if they don't tap into that point of interest first, and for us it was the 50% that was lying above here, if they don't tap into some specific level and then you see a model set up, show up for work, okay, watch the model. Let's do this, right? Remember, our ideal entry should have formed at 50% of this OB range to the left here. Now here's another example where we had everything work for us inside here. We had the first stab into the range and price moved away, right? People could have been profitable here. What do you think they would have done? They would have taken their stops from wherever they had shorted, say somewhere in here, stops above here, they targeted something down here, or they're targeting something even lower. The big boys would maybe have traded or trailed the stop down to break even, right? So the first tap in the range, you can get a decent move coming out of it, but understand that if the 50% is not mitigated, the second stab into the range or following stabs afterward will take you out. It has to take out early sellers. Now, when we came to this point right here, we may have taken this high here and this high here, right? Taken the trendline liquidity. You may be eager to short this. You'll say, okay, as price is developing, I see this FEG form right here. And if they close this FEG, I am going to short this. Why? There's a high to the left of current price. We've run above the high, so we could call that OLR, right? Number two, I would like to see this FEG being closed below for my market structure shift to be framed. Okay, let's see. It should be right there, right? Let's just confirm that right there. So once this specific candle right here closed below this FEG, there are people who would trade this IFEG like this, take a short position on the close, stop above the highs, right? You don't put your stop, you don't ever put your stop inside an FEG, because an FEG is fair value for either buying or fair value for selling, and then they're targeting some low to the left. Unmitigated order block or OB range, flash range, whatever it is to the downside here. Let's go, right? Now, we had, let's just write this again. Number one, we had an OLR. Number two, we had MSS. We just closed below an opposing FEG. Number three should be what? CSD. So now I'm looking for CSD, and that's going to occur all the way down here. I need to close below this point right here with a candle body for me to trust that this is going to go down lower. Even if they retrace inside the range, I could pyramid, I could add, I could trust that this is going lower. So as this plays along, right, we come back into the range, we wick. What happens next? Look at that. We get taken out. We get taken out. And it all stems from the fact that our original point of interest was not tapped in the first place. So if we were expecting a point of interest to be tapped, it only happens here. It didn't happen here. If the level is not tapped, or if we come into the level, never ever play the first tap into a level. Demand that when a level is tapped, right? We've taken liquidity, a level is tapped. Demand that the high that was created inside here get run at least one more time. Take out any sellers who have entered early here. Take them out, even if it is by a wick, by a pip. Take them out. So you see here that we had OLR, we had MSS, no change in the state of delivery. You pause right there. No change in the state of delivery to the downside, right? But you get a change in the state of delivery to the upside, where we have come into a level, a BPR inside here, right? Down, up, down. This is a balanced price range. This should be 50% here. I'm almost certain of it. Right there. 50%. We've come into an area. We've then traded above the high of a down candle, causing a change in the state of delivery, right? Aggressive change in the state of delivery. Any retracements back into this order block right here should be for buying. Down candle printed inside a BPR. We took its high. Retracements back, you can see almost to the opening price exactly. We can show it to you now. Opening price of that down candle right there. You could have taken a long, and these are for the Coke boys like this, right? Put your stop below there and target this high or target 50%. Now I'm going to show you how this works, right? So in the absence of CSD, you are not interested in any contrarian positions to the downside, because you may have got step 1 OLR, step 2 MSS. There's no step 3. There's no step 3. No step 3. Stay with current order flow, right? Don't expect step 4 and step 5. But give me step 3, like you did here, OLR, MSS, change in the state of delivery. Let's get to the change in the state of delivery right now. Right, give me the change in the state of delivery right here. Give me number 4, which said expect a measurement of retracement. There's your retracement coming in. There's another OLR, or internal range liquidity, being generated. And the first sign of CSD at your point of interest, so number 5 would mean expansion. At the first sign of CSD, which means we come into a level on the retracement, step number 4. CSD, this candle right here. There we go. We traded below its low. You could treat that candle specifically as an order block. And any retracements back into that order block, you could do something like this. Opening price of that order block, stop above the high, target a Dexter fib low, right? Let's see how that looks. Take this to this, target 2 standard deviations right there. So come into a level, take liquidity, trade below the low of a down candle right here, retracement back inside that range, enter, go short. Now we have achieved 5 steps in the sequence that we require for a delivery to take place. And if in the absence of step 3, which was the change in the state of delivery, you don't even bother about step 4 or step 5. But when you get step 3, which is a change in the state of delivery, have the patience to expect a measurement of retracement back into the range, imbalance inside the range, 50% of that range, like we did right here. 50%. Then give me another change in the state of delivery, which is telling me that I'm now done with going up or being bullish. I want to go down. For those who are astute or aware enough, you will understand that as we create up candle ranges and we close below them, these become bearish order block ranges. We could do things like this right there. And this is where flash comes into play. Remember, flash is a lower high which leads to a lower low. Flash creates a balanced price range. Candles up, candles down, balanced price range. What does a balanced price range seek? 50%. There you go. 50%, price moves down. Again, come to the concept of first stab into the range, move away, second stab into the range, because remember, people who have shorted here, as price starts to move down, they want to be aggressive and go to break even. Boom, bang, take them out, change in the state of delivery as we trade below this low, wick back into the range, gone again. And you will continue with the flash logic, because flash logic is propulsion block logic. What does that mean? It means when we have up candles creating a range, and then we have up candles trading to up candles. See, up candles trading to up candles. Follow the same logic of flash, where you have a range being created from a lower high to a lower low. There's your range right here. We are not concerned with any range that is prior to this range right here once we close below it. After we close below it, all our focus is on the most immediate order block range that is above current price. There's your flash range. We've closed below it here. Identify any imbalances in the range. Can you identify any imbalances in the range? Yes, you can, right there. Wait for your point of interest to be hit. Wait for a change in the state of delivery. Once we trade below the low of this up candle right here, treat it as an order block. Wait for retracement back into the order block range, opening price. Go on again. Is this starting to make sense? And you will keep doing this until we start to trade above the highs of up candle ranges to the left of current price. So when they create an up candle range and they close below it, they create an up candle range, close below, create one, close below, come back, create one, close below. When they start to trade or close above them, we are no longer bearish. They have created a change in the state of delivery, market structure shift, order flow has changed. We are now looking for what? We are looking for buy setups. Again, identify the order block range. You want to close above the most recent up candle range high, because this gives you what? A change in the state of delivery. You have, again, you do the thing, right? OLR, MSS, right here. There's an FEG. We've closed above it. It creates a market structure shift. We've closed above the high here, which creates a change in the state of delivery. So we go on to number 4 now. So number 1, we had OLR. We had the MSS coming inside here. We had the CSD up here when we closed above there. Number 4 states that we need a measurement of retracement, and ideally that would form at 50% right there. And number 5 would be expansion, right? So when we get number 4, remember there's the way that I'm framing an OB range is from the bullish order block right here once we close above it. ICT, or you have been taught as well to frame your range from the low to the high and then buy in discount. Same thing over here. There's the discount of this bigger range. We'll just make it red for this sake. You can see that this is also in the discount of this range, right? We are at the 50% of this OB. That's what I'm interested in. What do you do now on this particular time frame? Say it's an H1. You are waiting for a change in the state of delivery, right? Where does that occur on H1? Either you can be aggressive. If this is the order block that you have identified, you want to see a close above 50%, that is being very aggressive, you buy there, right? Or you wait for a change in the state of delivery. When we wick through that high, expect a measurement of retracement back to 50%, taking any internal liquidity. You can buy this blind with your stop below here, right? But remember, there's still an FEG to the left, and we don't like to put our stops below FEGs. So what do we do then? We could look for any, or wait for, stay on the 1 hour or drill down to a lower time frame. If you are staying on this time frame because you want to be a high time frame trader, here's the order block down candle body right here. Wicks into your level, takes liquidity to the left, closes or wicks through the high of the down candle. Buy any retracements back into this range right here. Let's get rid of this guy. Let's get rid of this guy. Any retracements back into this area, you're going to be buying. You spam that buy button. It's the same logic, but in reverse as we start to move up create down candle body ranges, right? This range right here, close above them, buy retracements back into them. Create a down candle body range, close above it, buy retracements back into it. Close above it, buy retracements, and so on and so forth. You keep on doing that. It's the same thing over and over and over again, right? So this is how you would use trading an OB model with flash or zoom effectively. Understand that 50% of that range has to be mitigated. The first stab into the range is always those early sellers, early buyers. They must be taken out before price needs to move. Understand that once price has created an order block range and moved away from it, there is no speed away from that order block until that order block is mitigated. Mitigate the order block, then the speed will come. It's the same thing over and over again. Go back and look in your charts. It's the same thing over and over again. Go and look at any piece of price action that you can find. We take liquidity, we have a change in the state of delivery, buy retracements back into the order block. Look for a change in the state of delivery here. Here's a perfect example of a Coke boy setup, right? Perfect example. This is a modified aggressive setup. And when I explain to you that you only need 3 or 4 candles for the setup, you're going to understand why. Find the first stab into a level. Wick. Let's do this, right? Let's zoom in here. Important things being discussed here. We wick into a level, or we push into a level. We then wick that level. And what do wicks tell us? Wicks tell us that there is no willingness to go lower. If there's no willingness to go lower, if we wick this low and close back inside the range, all I need is a down candle high to the left to be traded through for a change in the state of delivery. And I could treat this as an order block, and any retracement back into the range after the change in the state of delivery, I will buy it. Change in the state of delivery occurs here, you buy this wick here. Now, if you want to be like me and be more specific, then I would buy the opening price of the rejection block which has been created right here. Right? Treat this as a rejection block right there. Here's your opening price right here. We'll make it black, we'll make it darker. So whatever we achieved here now, we wicked below a low telling us that it doesn't want to go lower. We traded above the high of a down candle to the left, creating a change in the state of delivery. We wicked back into the level. There's the opening price. It got the wick right here, and price moved away. It means your setup could have been this. Enter at the opening price, stop below the lows, target this high, any high to the left. Right there. Now, understand what I just did right here is the same thing as what I'm about to draw for you right here. Is this a failure swing, an opposing liquidity run, change in the state of delivery, retracement, expansion. It's the same model, right? Can you see that? But we framed it on a candle by candle basis. But essentially, what have I framed? Have I not framed a zoom here? Same thing. Exactly the same thing. wick a low, close back above, or wick a down candle high to the left, buy the opening price of the rejection block, or any retracements back into the range. What more do you need? Giving away too much information here right now. I see a lot of you guys want to talk about ONS, right? It's not really my place or concept to speak about, but basically it would entail identifying the range. Let's have a look here, right? Let's see what we can do here. Since I don't want to put up the indicator for it, it would be Chicago, New York would be 5 a.m. to 9:15. Right there. That's your range. Whatever is framed inside this range, from the low to the high, that's the range, right? We could have done, and you would go about doing this backtesting through all of the different time frames. Now I actually have an indicator that would show me all of this, but basically this range serves as a look back function when the market opens, which means if the range is efficient, right, there may not be a need to trade too deep back into the range. If the range is inefficient, yeah, sure, they'll want to trade back in, even take the low of the range. Because this is a look back function, think of it as some sort of accumulation, and we could have a manipulation above, then target the low. We could have a manipulation below, then we start pushing higher. This would depend on what your bias is for the day, but in this case, no willingness to go lower. They come and make this portion of price efficient. We have this wick down here that closes back inside the range, right? Closes back inside the range. Wick below there, close back inside the range. We don't get any change in the state of delivery just yet. We get it here, price just moves away. This is just one of those instances on an M5 where you don't get a setup on this, right? But I can't manually draw this for every thing on this chart right now. But go back and look at that range and see whether it's inefficient or efficient. You would know if it's inefficient or efficient. Let's go back here, right? Meaning, if this was the opening price of that range right there, right? That's the opening price of that range. Price moved away, came back down. Being efficient or inefficient basically means that we need an equal number of up candles and down candle bodies within a range for it to be efficient, right? You can see that there's a portion of price right here there's a portion of price right here that hasn't come back to the opening of this range. So it means everything below here is inefficient. It needs down candle bodies to print down there. Everything above here, efficient. Equal number of down candles and up candles. Above here, inefficient, comes back, makes it efficient. It's the same story here. It's the same story here. But here, it just trades back in. We want to ideally see down candle bodies coming back and printing. This is the difference between efficient and inefficient, right? How would you handle trading price discovery with new all-time highs? It's a very difficult thing, right? You don't have any levels to watch out for. What do you watch out for? What do you know what to target? So it all comes down to playing structure. All comes down to playing structure. Now, I didn't get any opportunities at the open today to take any trades. The only trade that I did frame but did not take is this one right here. Right here, I'll show it to you. We wick a low right here. We have a change in the state of delivery. Price closes above a high. So ideally, I have everything here. I have an OLR, I have the CSD. I just need to see retracement, another change in the state of delivery here, and expansion. I'm good to go, right? If I use the same concept that I just showed you right now, it would mean that I would want to see my entry form at a rejection block down here. CSD here, the bigger CSD right here. So we had OLR, we had MSS inside here, we had CSD up here. There's your retracement coming in here, right? When we get to this point and this specific point of interest right there, I'm now interested in what's going on right here. And for that to happen, I need liquidity to be taken, which we did right here. I need a change in the state of delivery, which happened right there. We traded, we wicked this low again, we traded above this high. I want to see retracement back into the range, and if I have the order block range identified, or if I have any untapped lows inside that range, this is where my entry should form. Inside the order block that took liquidity, like so. So you could have framed the trade just like me, either at 50%, stops below the low, target a high, target something to the upside, whatever it is, right? If you don't know what the targets are, and which is likely the case right now, you target 2 to 2.5 standard deviations or 4. Why? You don't know. This is all-time highs. You don't have any reference points above current price. This is making new highs constantly. You would default to what market structure is telling you. If market structure is telling you we've shifted bullish right here, switch to flash. Create a range, close above it, retracement to 50% long. Create a range, close above it. You want to see 50% tapped. Here's another instance where we have a pushback inside here. We don't tap that 50%, we push away. Suddenly you get an OLR or liquidity run coming back inside here, taking this out, and then what happens? Watch carefully what happens. After we've taken this guy out right here, price wicks a low on the M1. We wick the low. We start trading higher. ICT would call a CSD wicking through the opening price of an order block. We close above 50%, right? ICT CSD right here trades back down into the opening price of the rejection block, and an untapped low that doesn't form part of that rejection block, untapped low right here. Again, if you are not sure whether you want to take your long position like this and target this high right here, wait for another change in the state of delivery, wait for an entry to form inside this range, stop below here, wick down, close above, wick above its high, retracement back into the range, go long. It's going to be the same things over and over again, whether you're using a Coke boy setup or normal setups. Now, one thing that I do want to tell you or explain to you is, in the absence of any FEGs being present in the stop hunt leg, so say we had a stop hunt leg right here, no FEGs present right here, it's very difficult to be bearish if you wanted to be right here. There's no structure to the left here. There's no FEGs inside here. In the absence of any FEGs in the stop hunt leg, stay with current order flow. If that order flow is bullish, there's no FEGs here. You see an OLR, you see a violent push down, but there's no FEGs inside here. Any CSD that you take right here, wick down, change in the state of delivery, retracement, expansion, long it. It is the difference between a good setup and a bad setup. Look at all of these setups right here. All of these. Show me where in the stop hunt leg, and ideally above a high, that they printed an FEG, then they closed below it to give us a good model or a good setup. They haven't. Anywhere inside here. All you saw was choppy price action, spikes down, go back up, spikes down, go back up, constantly. And there are times where they will accumulate at one particular order block or range of price, like you saw here. It becomes a difficult thing. So as per TCM, 4 a.m. candle is 5 in New York. Yes, that's correct. The FEG should be on the left. Yes, the FEG should be on the left. The FEG should be on the left of what current price action is, right? Let's find one for you on this particular chart. There's one right here. Can you see how there were many FEGs being created inside here in a stop hunt leg, and then we closed above it? Market structure shift, retracement, expansion. Compare the look of what happened here, even this setup right here. Look at it. We OLR'd here. We had a change in the state of delivery here. Market structure shift, there's a tiny FEG inside here. Market structure shift, CSD here, retracement back into the range, expansion. A quick 30 or 40 points there. Again, FEG being closed through, market structure shift, retracement, expansion. So in the absence of any FEGs being created in a stop hunt leg, it becomes very difficult to frame a good setup, right? It's the difference between a good setup and a great setup. I'm not saying that you won't see or you can't be profitable with taking an entry without an FEG being present. But when there is an FEG being present and we close below it, it becomes even better. Right? That's for reversals. Reversals require a point of interest, first of all. We need a specified point of interest. We need an OLR to occur, whether it was here, running these highs, closing below this FEG, right here, retracement into the range, short. And even in this instance right here, you can't be extremely bearish until we close below this range right here. Until we close below this range, you can't be extremely bearish. The max expectation for any short position that you would have taken, say right here, should be 50% of this order block right there. You need them to close below here, right, which would give us OLR, MSS, CSD, wait for the retracement to kick in, then the expansion. A BPR and an efficiently traded range is essentially the same thing. BPR would, there's many different, the strictest definition of a BPR would be an FEG overlapping an FEG would create a BPR according to ICT. So FEGs overlapping FEGs create a balanced price range. I am only interested if you look at how price moves, where you create something with a wick and then you close back above it. This is essentially a BPR for me, or an efficiently traded range, because inside this wick price did this. We wicked up, we came back down, we then went back up. 3, 1, 2, 3. 3 passes through that entire range. So we require that FEG to be in the stop hunt leg because it is a mile marker for us, so to speak. When we see them push hard through a level, right, creating breakaway gaps, all of these breakaway gaps become fair value for buying. It means that they should contain price and send price higher. Old highs are fair value for buying. It's why breakers work. You can see here, right? It's why breakers work. Now, when they create these breakaway gaps and then they close below them, we are essentially saying that fair value for buying has now flipped to fair value for selling. When this guy closed below this FEG right here, it rejected and it pushed down. Back way. Think about how ranges become efficient. How does a range become efficient? If we left this entire range right here, right? Highest body to lowest body right there. Forget that there was anything to the left of this, right? This range is efficient on the way down and on the way up to this point where there is a candle body right there, right? Get rid of this. Everything below this line is efficiently traded. We traded above it. It creates one-sided delivery, which is inefficient. So when you are targeting anything from here back down inside here, you want to see ideally candle bodies print at this line here to make this inefficient delivery efficient again. So if you look at the concept of efficient and inefficient, right? Understand what I'm saying. Go back to that H1, whole area of H1 that we were trading. Right here. If I used that concept of being efficient or making price efficient or the range efficient, use the same logic. At this opening of this order block right there, right? Let's get rid of this. Price went higher and it closed through here. This portion of price from here to here is efficient. It is a BPR, right? An efficiently traded range or a balanced price range. For the range to become efficient, if I was targeting anything to the upside all the way down here, whether I used a flash model, retracement into here, expansion, retracement into here, expansion, I am then ideally looking for up candle bodies to print at this level right there, which means this didn't make it efficient. This did not make it efficient. This made it efficient right there. So if you have any piece of price action that you want to draw on liquidity, it's making the range efficient again. Efficient here, one-sided delivery inefficient, make it efficient. You could then subdivide it to more specific areas where everything inside here is efficient. Below this one-sided delivery, you want to target just an up candle body to print right there and make that efficient. It could fall off a cliff, it could continue higher, you could care less. You just want to make this specific piece of price efficient, and then you'll see what your next step is. Understanding what the daily bias is, right? It's a loaded question. And you would have found me talk about an algorithmic draw, right? And basically what an algorithmic draw is, on any specific day, if I notice that price is failing, let's think about this clearly, right? What would your bias be here? Here's your previous all-time high. Here's FEGs inside here. There's two here. If there are two FEGs, always use the second, right? Price comes back, taps into this FEG here, rebalances this inside here. We then fail to close below lows to the left of current price, right there. We fail to close below lows to the left of price after we've balanced this range right here, these imbalances. So if they've delivered to sell side, right, inside these bursies, buy side imbalance, sell side inefficiency, the job here is done. They should want to deliver to buy side, which is here, here, and here. So these are where biases are formed. Think about the concept of targeting highs and lows based on whether candles are efficient or not, right? And we could easily say that when this specific H4 candle failed to close below these lows, its high became a draw on liquidity. So I'm marking that off. When this H4 candle right here failed to close below lows to the left of it, this becomes a draw on liquidity right there. It's high. So on and so forth. Fail to close above highs, draw to its low. See that? So imagine now, like my point of interest for today specifically, or this week, wasn't even an all-time high. I'll be honest with you, wasn't even an all-time high. I wanted this to take more time inside this range before pushing higher. I had this range marked off here, and specifically untapped highs inside the range right here, and the H4 algorithmic high draw right there. That's what I wanted today. And remember, today's candle started off here, down here. How many points is that so far? So there are many ways. That's 210 points. There's many ways to identify what a draw on liquidity is based on low time frames or high time frame previous draws. You could, if you were at these lows and you were targeting something to the high, what would you be looking for? What would you be looking for? You'd be looking for any order block ranges that are untapped, unmitigated. Let's say right here. You are looking for any highs that are untapped, like this guy right here. See how it taps and moves away? Anything untapped? This guy right here. These guys right there. See that? So you're looking for areas of demand or supply, order block to order block, supply to demand, demand to supply, any imbalances inside here. But let's look at range efficiency. All of this is all efficient, all down here. You could have maybe targeted this piece of price action right here to this point because you wanted an up candle body to print here. There you go, it does. So the concept of a point of interest is vast, right? It's vast. Your point of interest could be just a Dexter fib or your drawn liquidity right there. It could be all the way up here, all the way up there. All you have to understand or remember is that when candles are closing above range or high, so if this daily candle closes above the all-time high, that's not bearish. What that tells you is find the mean threshold of that range and look for any retracements back inside of it, right? That comes to here. If you get any retracements back inside this range to here, long it, because it is showing you willingness to go higher by closing above the range. Retracements are for longing. It's only when they wick below or above range lows and highs that there's no willingness to go lower. Target the other end. There's no specific important times in gold as such. I try to avoid trading gold. Gold is crazy. But it doesn't mean that the concepts don't work. The concepts work. They all work the same. Whether it doesn't matter what time frame you are on or at. What is this? Today's Tuesday. Let's look at Wednesday, right? And this is on UTC -5, so let's make that New York right there. Right, market opens somewhere inside here. We have a sweep of the high, pushes down back inside this range here, and all it's doing, if you are familiar with the flash model or the OB model, it is just doing that, right? It's pushing back inside a previous range, in this case a second tap. Here's your first tap, price pushes away, there's your second tap, taking liquidity, change in the state of delivery, and it's gone, right? On a lower time frame, I'm sure you could have found an entry inside here. Almost certain you could have found an entry inside here. Right? Change in the state of delivery when we go higher here. Here's a bit of chasing, so not the best of entries unless you had order flow is bullish, but here not so much on this time frame. I'll be honest with you, you'd be chasing here, but here you could find one right here. You don't have to catch the lows or the highs. You just have to be able to identify where price closes above a high, comes back in, first tap, second tap into the range, change in the state of delivery, retracement, expansion, close above a high, retracement, expansion, close above a high, retracement, and it should have some expansion. Same things over and over again. No one is asking you to catch the low and the high. You never ever chase. Look at this. If you don't see you got OLR, CSD, right? MSS, CSD, no retracement. So what this tells me is at some point that they will come back down into this level. Even this level right here that is not tapped, this may be a first tap into the range. At some point they will come back to the second tap. Tap 50%, the unmitigated area or order block and then move away. So I won't say I'll trade specific times or tell you about specific times. I'll tell you about where price is efficient or inefficient and what price needs to do. Ben, these are always uploaded automatically by YouTube. So are there any more questions? If you guys have any more questions? I want to round things up. I've given you more than enough information using Flash, Zoom, OB model, Cokeboy entries, all of the stuff and more that you would need to trade. Yeah, of course, I have losing trades. I had a losing trade yesterday. I won't say I lost a lot, but yeah, there's always going to be some losing trade, and then that trade, this indicator here, it's just the ICT high time frame candle. So what it does is I'm on a 1 minute, I can have a 5 minute, 15, H1 and a daily all show up at the same chart, and I can see basically at one glance which time what's happening across all of these time frames. Remember, everything when you deal with technology or computers or software, anything that a human does or deals with has room for error, right? And most of the errors come out of user error, nothing more than user error. So if I accidentally framed, is this M1? If I accidentally framed a short incorrectly, let's look at something here today. There was a violent move down somewhere. US 100. Just trying to figure where that move. Here, I think. Is it Wednesday? No, not here. There was a move inside here that you could have got thrown with. I can't remember right now. Can't seem to find it. It's all about framing market structure, right? And whatever I told you, you are not interested in any range other than the most immediate once we close above it. Once we close above a specific range, can you show the name of it? I wasn't able to scoop it. The name of it is ICT high time frame candles. That's what it's called. Market structure here, bullish, retracement, expansion, retracement, expansion. Now at this point, for example, they could have easily done something like this, because this is the previous range right here. But once they did this and closed above this range, I'm no longer interested in them coming all the way down here. I would look for an entry inside here, and once we close back above it, retracement, expansion, retracement, expansion. And as long as they are not closing below the lows of down candles to the left of current price, you would stay bullish, because closing below those candle bodies to the left is where the CSD comes in. I can't really take you through through ONS, right? Not here, at least. It's not my concept to teach, but basically Chicago time, 4 a.m. to 8:15, draw the range from the opening price, right, to the highs, mark the range out, and when New York comes in or opens up, if we take one end, try and target the other for liquidity. Once we take this, put down candle bodies, whatever it is, change in the state of delivery, retracement, expansion, so on and so forth. Yeah, I haven't traded crypto in a while, Zorab, but again, these concepts are not exclusive to only indices or only stocks or gold or anything specific. This can be used on anything. Can be used on any time frame, anything. So look here, for example, right? Here's a down candle body to the high, right here. We have an OLR, we have a CSD, we have the retracement. Now watch how fun this can get if you pay attention, right? Pay attention, and this is a daily time frame. 50% tagged. We then have an OLR here. We have a CSD here. We have retracement back into this order block right here. There you go. 50% expansion. What expansion would that be, or what would you expect that to be? It could be something like this. 2 to 2.5 standard deviations. There you go. Right there, you could take a short position at 50% with the stop above that high right there, target 2 standard deviations. So the concepts are universal, right? The concepts are universal. It's up to you to decide or determine how you would want to use this. I don't do any fundamental analysis as such. It's purely technical, but obviously I'm keeping track of what news there are on specific days and the times those news would come in. Obviously not trading before news, depending on when the news comes or when the news would be, right? Actually kicking myself for a long that I had all the way down here yesterday. Just trying to find a Tuesday's low down here. It was all the way down here. I had a long inside here, and I should have held that. I should have held that long. Again, same things over and over again. Market structure shift, CSD, retracement, expansion. I was inside this right here, right? Same thing. I'm at a point of interest. I wick a low. I have CSD here. I have retracement here to the opening price of the rejection block long. I'll rewatch your recent videos, and thank you so much for these videos, eye openers. Yeah, no problem. No problem at all. So I'll round this up. Obviously, this will take some time. It will be available on my channel under the live portion of it. If you guys are interested in, I'm not sure if you can see this. If you are interested in joining the Discord is, let's have a look if you guys can see this, right? The Discord is, this is the paid side of it, right? We have a war room. This is the public chat. This is the war room. All streams get uploaded here. My intraday analysis goes here. We have daily calls that get run by one of my team members. So every day you would find a Zoom link being sent out, and all of the members join, and they trade live, right? They trade all of these things that I'm showing you now are traded live every day. I have a good friend called Umar, who's actually a trading psychologist, and we've given 4 or 5 of the guys free. They've actually won it. He did a draw and they won free sessions with him, right? He's a certified trading psychologist. So that's for the emotional or psychological part of your trading. He will assess and tell you what can be improved, how you should improve. So that gets done there. The boiler room is where the crypto stuff happens. Normal questions happen inside here. And then all of my streams daily happen all inside here, right? All inside here. And then the war room right here. All the chatting goes on there, right? And if you are interested in joining that side, then let me just see if I can pull something else up for you, right? Give me a second. You're not going to see anything on the screen right now. WAP. Just give me a second. I'll try and pull something up with WAP. Right, so I have a link that's attached. WAP. Let's see if I can get to WAP. I have a link that's attached to this stream. Right, you'll see it here. I'm just going to try and get to the link now. Give me a second. Announcements. Can't remember where I posted it. Just give me a second. Right, this would be the link here. I'm going to show it to you in a second. Right, so I've decided to move to WAP, and the seats are very limited, right? So I'm not interested in a very big group. I don't want a big group of people running around, me having to entertain a lot of people. The group is or will be capped at 100, and we're almost there. It's 53.50. I know it's such a random number, but WAP has some fees in that. So when you click here, you'd automatically get access to the Discord, all of it. That comes with 1v1 calls with myself, daily live calls, group calls, charting, the in-house psychologist, live chat, and then there's a discounted yearly option, and then there's an option if you don't want to join the Discord but you want to have a one-on-one call with me, then that's fine as well. So we do that all day, every day. And at 100 members, the group's going to be capped. It's not going to be anyone else inside it. I don't care for the money or having a big group, right? 100 members max. Right, so if you guys have any more questions, you can ask them to me on my public chat in the Discord or my public Telegram or Twitter. Vinayaka, I don't do any fundamental analysis. I have a few guys that do that inside the group, tell me what's going on. The only thing fundamental that I'm concerned with is times of the news in relation to what my bias and what I want to see or trade. Again, I'll post a link to the recorded version of this. It will be available under live in my on my YouTube channel. And I think we covered a lot of saucy stuff inside here. So next time maybe we'll stay away from the saucy stuff and we'll cover, maybe do some technical analysis, right? We'll do some technical analysis. So if there's no more questions, I'll give you guys about 20. You try and trade the SO Stoic. I try and stay away from seek and destroy profiles. There is actually one specific seek and destroy kind of profile you find on an ONS as well. Takes both sides and then just plays around inside the range, and then it pushes up. So not the most fun. Not the most fun. Your core understanding is just going to come from understanding market structure and ranges, right? This is clearly bullish. All of these candles clearly bullish. So short opportunities are only born when CSD occurs, lows of down candles are closed through. That's when short opportunities are born. Other than that, your job would be to look for opportunities to buy and send price higher. We don't know how high it could go. We really don't know. No one does. We are in uncharted territory. No one knows. It could be some specific FUB level. I don't know. I don't know. All right, I'm going to end the stream here now. No problem, Carlo. No problem at all, right? You can see the same sort of vibes happening here, by the way. High being taken, and then suddenly we're getting speed up. Then we come down here. So sort of same vibes, right? Speed through the highs, and then maybe we come down here. Who knows? All I'm interested in is structure bullish or not, and how can I stay with that structure on whatever time frame I'm trading. Right, cutting the call now, and we'll take it from there. I'll see you guys later. Thanks for joining.